Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 29th September. Coming up on the show, President Trump is set to meet with top congressional leaders as the clock keeps ticking on a government shutdown. Global stocks get a boost after the latest US inflation reading comes in as expected. And gold prices, well, they keep on surging. So grab your coffee and let's own the morning. President Trump will meet with the top 4 congressional leaders at the White House later today as a potential government shutdown looms. The bill at issue would only fund the government until mid-November and must pass before October 1st. Democrats are insisting it must include an extension of healthcare subsidies and a restoration of budget cuts to healthcare implemented by Trump's signature legislation that passed earlier this year. Republicans say negotiations for those issues can happen after averting a shutdown. Now, these Republicans will need at least 7 Democrats to back the short-term bill in the Senate, which has already passed the House. Yesterday, Trump again threatened mass firings of federal workers if the government shuts down. But what exactly will a shutdown mean? Well, our very own Julie Hyman explains.
A partial government shutdown is just days away as lawmakers continue to debate a spending agreement. So we're taking a closer look at what a shutdown means for you and your money. Essential services will continue through a shutdown, including military, law enforcement, the Postal Service, the Federal Aviation Administration, and the Transportation Security Administration. But those workers will not be receiving paychecks. During past shutdowns, some TSA checkpoints were closed, and travelers faced longer lines when agents didn't show up for shifts. Non-essential services like national parks will close. In the past, some parks were kept open with state help, but with fewer visitor services, leading to reports of damages and trash pileups. The Smithsonian museums also typically close within a few days. As far as benefits, federal Medicare and Medicaid health insurance programs are considered mandatory spending. That means benefits will not be impacted. Social Security will also continue to be distributed, but staffing in some services could be affected and could cause slowdowns. As for SNAP benefits, they'll only be affected if the shutdown lasts for more than 30 days. That's because funding typically only allows the Agricultural Department to send out those benefits for 30 days after a shutdown begins. And when it comes to the market, stocks are typically pretty indifferent to shutdowns, with the S&P 500 rising more often than falling in the past. But it could have an impact on economic data, delaying key releases like the jobs report and CPI report.
Well, the first thing you need to know is that markets look set to open higher this morning. Why? Well, on Friday, we learnt that core inflation was little changed in August. That's according to the PCE price index, the Fed's preferred inflation gauge. Now, the monthly number came in at 0.3% and the annual headline number 2.7%. That means that the central bank is on pace for interest rate reductions ahead. The next thing you need to know is that gold has hit another record high this morning. In fact, prices surged past $3,800 an ounce. They were driven by rising bets on Fed rate cuts that are weakening the dollar, but also concerns over that possible government shutdown, making the safe haven asset even more attractive. Now, gold, which benefits from lower interest rates and thrives during geopolitical and economic uncertainty, has gained more than 40% year to date. And the final thing to know is that oil prices, well, they're declining. Why? Well, it's expected that OPEC Plus will likely hike oil production again in November. Recent price rises seem to have encouraged the cartel to try to regain market share. OPEC Plus, which includes Russia and pumps around half the world's oil, has reversed its strategy of output cuts from April amid growing pressure from President Trump to lower oil prices. Now, OPEC Plus will actually meet on October the 5th. Well, to discuss some of these stories and much more, I'm joined by Anna McDonald, Investment Manager at Aubrey Capital Management. Anna, thanks for joining us here on Market Sunrise. Well, let's start with the Fed. We're going to hear from some Fed speakers today. But since the Fed cut earlier this month, what have you made of the comments you've heard from Chair Powell and, of course, the newest member of the board, Stephen Myron?
Well, I think if they really throw into sharp relief that we have 2 divergent schools of thought now on the Federal Reserve. We've got Powell, who's trying to be cautious, data dependent, thinking about the effects of ongoing inflation, which is still, as you say, it might come in ahead in line with expectations, but it is still ahead of target. So he's got that cautious, data-dependent attitude. And now Moran has taken an unpaid leave of absence from the White House, where he was chair of the Council of Economic Advisors. And he's coming on and he's talking about a need for much bigger rate cuts, 50 basis point rate cuts. And he's talking about, that the economy is not cratering, but there's definite signs of weakness, and that Trump's actions have actually changed the outlook really for the way that the market should think about inflation. He's been a lot of work on immigrant workforce, for example, and so he's saying that the market sort of structures have changed a bit. So it's really interesting what they're saying, but remember, Moran is just one vote, and there is a much broader Federal Reserve. So I expect that the other members of the Fed will be thinking more along the gradual and slower rate cuts in order to not get that unanchoring from the inflation expectations that we want to have in the market.
Now, our top story today is the fact that there's a potential government shutdown looming, but that could have a big impact on the Fed as well, because on Friday we get the non-farm payroll report. What could happen if we don't get the non-farm payroll report? But also, the number that we're looking at, the expectation is for quite a low number, just 22,000. It seems like if there's a miss, there could be quite a big impact on the markets.
Yeah, I think so. And actually, if you think back, that August number of 22,000, it's about the revisions they do going back. So actually, it showed that in June there was actually a negative number there. So I think it's always interesting to see not only what they're coming out for this month, but what they're saying, any revisions to previous months. I think September that we're looking for 50,000. But as we know, these numbers might not even be published if there is a Fed shutdown.
And talking about the Fed shutdown, my colleague Julie Hyman said it might not have that big an impact on the markets. Are you in agreement with that?
Well, I think we're seeing an impact in gold. One of the reasons I think that, you discussed earlier about, it's a bit of a safe haven asset, up 45% this year. And as the dollar continues to weaken, it actually becomes a more attractive asset for those overseas who might be now thinking, because there's been a lot of, let's face it, there's been this second administration by Trump has been very different. And there are some overseas investors that may be thinking about buying gold instead of treasuries. And that looks increasingly attractive when you have things like government shutdown, which don't normally have more than a short-term impact. But I think we've got a particularly febrile atmosphere at the moment, and that might be leading investors into gold rather than treasuries.
Now, it's a pretty quiet week on the corporate earnings front, but we do hear from the sporting giant Nike. What are you looking out for there? It's been a bit of a tough sort of year for them so far, hasn't it?
Yeah, it's been a tough couple of years, actually. The CEO has Elliott Hill. He came back having spent 32 years as Nike's head of commercial and marketing, and he's come back to be CEO. And I think he's going back to thinking about all his marketing expertise. We're going to see quite a big increase in marketing budgets, particularly ahead of the World Cup next year. Nike are the suppliers to 5 of the top 10 teams that are in the FIFA rankings for the World Cup. And I think they're seeing this as a big opportunity to try and regain market share, which they are losing to maybe some new brands like Hoka and On, which, these are small brands, $2 billion brands, not like Nike that's just shy of a $50 billion juggernaut. But I think that they need to cement themselves as serious. They've already tried to cement themselves as serious players in technical trainers, really good trainers and football boots and so on. But I think they're going to be looking to try and to spread that halo effect broader around and get more people back to buying Nike.
Anna McDonald from Aubrey Capital Management, many thanks for your thoughts. Okay, it's time for a short break now, but when we return, Yahoo Finance's Jared Blickery tells us what we need to know about stagflation. Welcome back. Well, Jerome Powell said last week that there is no zero-risk path to avoid stagflation. So what does stagflation mean, and why is this somewhat ominous word making a comeback these days? Well, markets and data editor Jared Blickery explains everything you need to know about stagflation.
Stagflation here means three warning lights flashing at once: weak or negative growth, high unemployment, and high inflation. Stagnation plus inflation. And some folks draw a line between capital S, the 1970s kind of stagflation, and the lowercase s when only parts show up. And since the pandemic, we've really only seen the lowercase kind. So let's break down the three major components right now. Starting with economic growth, we have GDP, or gross domestic product. It's the home field scoreboard. It's what's made inside our borders, and gross national product, or GNP, tracks what Americans earn anywhere on the planet. You also have gross national income, GNI. It rolls up wages, profits, and taxes, less subsidies. And fun fact, economists often watch GNI when profits or labor income look out of step with GDP, like right now. Then there's inflation. You've probably heard of the Consumer Price Index, or CPI, which is a household shopping basket. There's also personal consumption expenditures, or PCE, which is a broader base instrument, and it adjusts for substitution, and that's why the Federal Reserve likes to use it. And we should also distinguish between so-called headline inflation from what's called core. Headline includes food and energy, while core strips these volatiles out to see the trend. And for jobs, we watch the unemployment rate and how many payrolls are added or subtracted each month, courtesy the Bureau of Labor Statistics. We also like to watch the weekly filers for unemployment claims, since it's higher frequency. If claims start climbing while payrolls fade, that's part of the stagflation case gathering clouds. Now, let's check the history. Here in this table, we can see that in 1975 and 1980, we had a capital S, unemployment north of 7 or 8%, double-digit inflation, and contracting output as GDP plummeted. We didn't really have anything close to that until the pandemic in 2020, but there is a key difference. In the early days of COVID, unemployment spiked and GDP fell off a cliff, as we remember, but prices didn't rise yet. Price inflation actually dropped to nearly zero in 2020, which is almost deflation. So it was stag without inflation. But by 2022, all the stimmies finally started jacking prices higher, north of 9%. The economy shrunk modestly, but joblessness stayed low. That's only 2 out of 3. And today, unemployment is modest, PCE is in the high 2s, and GDP is fairly strong. Definitely not 1970s territory. And we'd be remiss if we didn't point out some market stats. It can be tricky to trade stagflation, and as I just said, that's really not even the case today anyway, but one thing's for sure, precious metals are soaring. Gold is up 40+% this year, and silver is approaching 60%. Metals love elevated inflation when the Fed is cutting interest rates, like right now. So here's what we want to watch for in the S checklist. On the data front, we're going to continue to watch jobs and CPI and PCE and GDP. We're especially keeping an eye on services inflation, as well as shelter, insurance, and healthcare costs. If these cool down, then core inflation cools as well. Then watch energy and the dollar. An oil pop or weaker dollar can reheat headline inflation pretty fast. And finally, this is a little tricky, but we want to monitor real incomes versus demand, which means workers' paychecks after inflation, and to make sure that they're growing faster than spending. Are people starting to dip into their savings and rack up their credit cards? That's a yellow flag. Bottom line, right now there is at least a chance of lowercase stagflation risk, but it's unlikely to get anything like what we saw in the 1970s or 80s based on what we're seeing right now. But if all three lights turn green, growth, jobs, and prices, well, guess what? That is your stagflation siren. And tune into more episodes of Stocks in Translation on the Yahoo Finance's website. We have new episodes dropping every Tuesday and Thursday.
Great insights there from Jared on stagflation. Well, we'll delve into trending tickers and we'll look at whether the AI hype is fading just after the break. It's time now for today's trending tickers. Well, let's start with CoreWeave. After a 200% rally this year following its IPO, the Gen AI cloud platform had some setbacks last week, as you can tell from this chart. But it's trending higher again this morning, around 2.5% up in the pre-market actually. Now, the impressive lineup of now down just under 2% actually now. Now, the impressive lineup of partners, think Alphabet, Cloudflare, and of course Nvidia, keeps powering CoreWeave's rise, along with strong revenue growth and positive indicators. Okay, let's now move on to the pharma sector, which has been in the news in recent days with new tariffs and rules. Well, today, AstraZeneca is gaining some value after announcing plans to list shares on the New York Stock Exchange. Now, AstraZeneca said it would be maintaining its status as a UK-listed and headquartered company, but it's hoping to attract a broader base of investors via a New York listing. Two more stocks to know about. GSK is up as it announced a new CEO, Luke Miels. He'll replace Emma Walmsley in January. And UCB SA, it's a very big European company you may never have heard of. It's flying this morning after it presented positive trial results for several of its drugs. Finally, let's move on to electric vehicles and China's BYD, that's Tesla's main competitor in the EV space. Well, it's rallied today in Hong Kong after it reported that it expects to export up to 1 million vehicles. That's roughly 20% of its total sales in 2025. It's good news for the EV maker, even as it lowered its overall sales targets. And in the United States as well, the EV industry is in the spotlight. As you may have heard, a $7,500 tax credit is set to end tomorrow, September 30th. Some EV shoppers race to buy their vehicles this weekend. But the Tesla stock, well, it seems a bit unscathed this morning. Kevin Roberts from Car Gurus, well, he spoke to my colleague Josh Lipton.
I can say from our data, you can see that the sales rate has picked up. And then not only that, the amount of, the number of EVs on dealer lots has been declining, and the market day supply has dropped quite significantly from where we were, at the end of June, 108 days supply, and now we're under 45 days supply. So the message is clearly getting out to consumers, and they're looking to kind of snap up those EVs before that credit expires.
So now bottom line, Kevin, so now let's look ahead. So once we're past this tax credit, pull out your crystal ball. What do you think the EV market looks like ahead, Kevin? What would you expect to see?
So it's unknown. I've been taking a look at what happened in other markets where tax credits expired. If you look to Europe, you saw double-digit declines of EV sales afterwards. California is one we've been watching. It accounted for about 30% of EV sales last year. And there had been talk that they would be replacing the tax credit themselves, but recently it just came out that they're not going to be replacing that tax credit. So a large EV market that we could be seeing a drop in sales volume in.
Are there certain EV names, Kevin, EV makers that in your opinion, hey, these guys, they may be better positioned than others in a sort of post-tax credit world?
So normally I would have assumed that automakers might be looking to plug the gap themselves, but we're in a post-tariff environment, and that tariff tax bill, they're currently consuming most of themselves right now. So I don't know how much automakers are going to be able to really kind of foot the bill as those EV tax credits go away.
And Kevin, by the way, what does the used market for EVs look like? You have line of sight there?
Yeah, so there is a used EV tax credit. It's for vehicles under $25,000. So we've been seeing an acceleration in that market as well. Not as much as what we've been seeing in the new vehicle market, but there has been an uptick in that used EV market. And we've been seeing a lot more used EVs, particularly get under that $25,000 threshold. And so it's a small but growing market.
Well, these days we keep hearing that the artificial intelligence hype is fading, that companies can't deliver on sky-high expectations. And yet, this morning, I'm seeing more analysts making bullish calls on AI. Case in point, Alibaba. The Chinese giant has been winning back investor support after announcing big AI plans. And again, shares are ripping higher, now up over 3% in the pre-market in New York. Now, after closing higher in Hong Kong, this is happening after Morningstar raised its fair value for Alibaba's listing by 49%, basically saying there's still lots more room to grow. And Morgan Stanley is echoing that sentiment, saying in a new report that there's reason to be, quote, incrementally bullish on AI cloud. On the Ali cloud, in fact. the cloud offering that Alibaba is expanding around the world. Now, Alibaba is now up nearly 50% in 1 month, thanks to its big investments, including a deeper partnership with Nvidia. One reason to remain cautious, though, the ongoing negotiations between the US and China. Not to mention that elsewhere in the world, we are seeing some cracks in the AI hype. Look at Oracle, for example. It has lost more than 8% in the past week alone. We'll obviously keep watching this space closely as investors are starting to look at real returns after trillions of dollars of massive investment in artificial intelligence by pretty much all of the world's largest companies. Okay, speaking of artificial intelligence, we just got some breaking news out of China. Huawei says it's planning to ramp up its production of AI chips, stepping up efforts to compete with Nvidia in China. It's roughly planning to double production of its current AI chips while developing the next generation. Bloomberg is reporting that Huawei is set to make about 600,000 of its 910 Ascent chips, and even if its technology is still behind in terms of performance compared to Nvidia, it's expected to gain back some ground with its next generation of products. Okay, before we go, let's have a check-in on where the markets stand. Well, let's start with Asia. And most Asian stocks, apart from Japan, as you can see, rose after Friday's PCE inflation reading came in as expected, as we spoke about earlier, hence increasing hopes for US rate cuts this year. It's worth noting that South Korea shares up quite heavily there, up around 8% this month. Now, remember too that Chinese markets will be closed from Wednesday for the Golden Week holiday as well. So watch for any big moves there too. Okay, let's move on to Europe now, and shares are also higher, basically on the hope that US rate cuts are imminent. Unusually, I was going to put in the Spain's IBEX on the board as well. I wanted to tell you about the 3 major credit agencies. They've all upgraded the economy, and just last week, the country's government and central bank upgraded growth forecasts in the country. So good news coming out of Spain. Let's move on to US futures now. And again, all in the green there, as you can see. And actually, a note just now out not that so long ago from Goldman Sachs. They've turned pretty bullish on US stocks. They believe that the US economy is showing signs of resilience and that we would not, we will avoid a recession. They say the recession risks are low, and they've turned overweight on stocks over the next 3-month horizon. Let's move on to gold prices. Let's check in on where we are now. Gold futures there, over $3,850 an ounce. And remember, that's a record high. It's still surging on that news that we've got a weaker dollar and also the potential shutdown in New York. Quick look at Bitcoin as well, which is also moving higher as well. As you can see, up over 2% as well. It had a pretty bad week, remember, last week, but it's now recovering. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.